Hi, this is Rowland from Money Markets TV. 2012 is almost upon us, so it's the perfect time to look back at the trends that unfolded in the world of exchange-traded funds over the past 12 months and look forward to the trends that are likely to emerge next year. Internationally minded investors have been able to fine-tune their geographic allocations with single-country ETFs for quite a while now. But in 2011, global small-cap investors gained the same ability. Single-country ETFs now cover small stock benchmarks in Japan, Canada, Germany, Brazil, China, India, South Korea, Russia, and Mexico, and many more are on the way. Meanwhile, the uncertain market environment of 2011 has made it more important than ever to find investments that minimize volatility. But traders are also looking for better yields than cash or extremely low-risk instruments like CDs. In response, ETF sponsors have introduced a new breed of fund that tries to balance between stability and growth. The methodology varies, and I'm not convinced all the ETFs in this category will be able to achieve their objectives over time, but it's still worth keeping an eye on these names. The third trend I observed in 2011 was the proliferation of bond ETFs. Like stocks, bonds come in many different flavors and risk levels. But bond trading in small amounts has always been impractical for most people. So I'm glad to see ETF sponsors make it easier for investors to target narrower slices of the bond market. So what's coming next? In 2012, I believe the current ETN format will bite the dust. I've been skeptical of exchange-traded notes for a long time. These hybrids can be useful in a few situations, but they have some major drawbacks, notably credit risk. The possibility of a bank going out of business has resulted in recent ETN offerings being met with little demand as more and more investors choose ETFs instead. Next year, some sponsors will finally offer to secure their ETNs by pledging the proceeds from the sale of the notes. This will make the current unsecured ETNs obsolete overnight. My second prediction is that unpopular ETFs will be culled. A large portion of new offerings are simply Me Too funds. Sponsor A enters a new niche, so sponsors B, C, and D create copycat products. But the sad truth is that some of these narrow segments just aren't big enough to support multiple ETFs. In most cases, assets gravitate to whoever made the first move anyway. I'm anticipating a big shakeout in 2012. The strong and truly useful ETFs will survive. The duplicative and useless products will disappear as sponsors tire of subsidizing them. My third prediction for 2012 is that Fidelity will finally make its move. Back in the 1990s, Fidelity Investments had a big lead in mutual fund assets, followed by Vanguard. But during the ETF explosion of the last decade, Vanguard has taken the lead, while Fidelity largely stuck to the sidelines. However, recent regulatory filings indicate that Fidelity is rethinking that decision. The firm has the capital and the marketing muscle to catch up, and I think they'll jump into the ETF business with both feet next year. Fidelity's big brokerage operation and deep access to the corporate retirement plan market will be its key weapons. They already offer no transaction fee trading in certain iShares ETFs. Imagine the same thing with dozens or hundreds of house-branded ETFs. And then imagine those same ETFs as investment options in the big company 401k plans. Will my predictions come true? We won't know until a year from now. But one thing I can be 100% sure of is that the ETF revolution is far from over. For Money Markets TV, I'm Ron Rowland. Have a happy new year.